In 2013, Alaska Airlines was making $235 million a year from a single partnership. It was its largest codeshare revenue stream, bigger than any route, bigger than any secondary hub. 4 years later, that number had dropped to $65 million, a 72% decline while Alaska was looking the other way. But here's the detail nobody talked about. The company on the other side of that partnership wasn't losing money. It was growing. It was building. It was mapping every route, every passenger, every connection Alaska had spent decades putting together. And when it was done building what it needed, it simply ended the contract. The question that defines this story isn't how Delta took Seattle, it's how Alaska handed over the keys and took 13 years to realize it. Alaska Airlines is not a small carrier that got run over by a giant. It is the fifth largest airline in North America, with more than 1,200 daily flights and its primary hub at Seattle-Tacoma International Airport, the 10th busiest in the United States, with nearly 25 million passengers in 2023. In Seattle, Alaska wasn't just dominant, it was the airport. Since 2002, its market share never dropped below 40%. During the pandemic, it crossed 50% and stayed there. But success has a problem, and it was exactly that dominance that made Alaska attractive as a partner for Delta in 2004. And it was that same dominance that Delta used as free infrastructure to build the hub that now threatens to take Alaska down. Alaska had the airport. It had the passengers. It had the domestic routes. What it didn't have was what Delta brought to the table: flights to Tokyo, Shanghai, London, and Seoul. And it was in that exchange that the game began, long before either side was willing to call it a game. Alaska built something that took decades to establish and gave free access to the competitor that threatened it most. Today, we're going to understand how this partnership really worked from the inside. We're going to look at the financial logic that made the codeshare valuable for both sides, and more valuable for one than the other. We're going to examine the exact moment Delta revealed that the plan was never to share Seattle, and we're going to understand the price Alaska is paying right now to rebuild what it gave away for free between 2004 and 2017. What no official press release made clear at the time is that the partnership had asymmetry built into it from day one. Mechanism 1. The domestic passenger flow. A codeshare, an agreement where two airlines sell seats on each other's flights under their own codes, as if those flights were their own, works like a funnel. Alaska operated an average of 287 daily departures from Seattle to cities across America. Delta had trans-Pacific routes to Tokyo, Shanghai, and Seoul. The agreement connected those two worlds. Alaska's domestic passengers arrived in Seattle and boarded Delta's international flights. In 2013, that generated $235 million for Alaska, the equivalent of a mid-sized American city collecting royalties for letting a neighbor use their sidewalk. Mechanism 2. Demand mapping. Every passenger Alaska handed to a Delta flight in Seattle was a data point. What city they came from, what their final destination was, which domestic route generated the most international connections. Between 2004 and 2012, Delta accumulated 8 years of operational intelligence about the Seattle market, without paying a cent of rent for that laboratory. In December 2012, CEO Richard Anderson publicly declared that the expansion to Shanghai and Tokyo is only possible because of our partnership with Alaska. It was confirmation that the model had worked exactly as planned. Mechanism 3. Building the substitute network. Starting in 2013, with the demand map in hand, Delta began replicating internally what Alaska had been providing externally. It grew from 40 to 150 peak day departures in Seattle, a 275% increase in 4 years. As Delta built its own domestic connections, Alaska's codeshare revenue collapsed from $235 million to $65 million between 2013 and 2016. Alaska was watching its largest partnership revenue stream get replaced, in real time, by the partner itself. In December 2016, Delta officially announced the end of the partnership. The press release used diplomatic language, a positive milestone for both airlines. Alaska would focus on integrating Virgin America. Delta would focus on creating more customer choice at its Seattle hub. In May 2017, the same month the codeshare officially ended, Delta launched 7 new markets from Seattle. Breaking Alaska's monopoly on domestic routes the partnership had left untouched for 13 years. It wasn't a coincidence, it was execution. Alaska had made the classic mistake of companies that depend on a strategic partnership without building an alternative in parallel. By 2013, when the erosion was already visible, revenue falling, Delta expanding, there was no replacement plan in place. When the cut came, Alaska was exposed. And this time, the stakes were higher. Delta didn't just exit the partnership, it left to compete directly with 3,200 local employees, its own terminal, and 13 years of market intelligence that Alaska had unknowingly financed. Alaska's response was to rebuild in 4 moves, each one more expensive than the last. First move, the acquisition of Virgin America in 2016 for $2.6 billion, expanding its presence in Los Angeles and San Francisco and making Alaska the largest carrier on the West Coast. Second move, joining the One World Alliance in March 2021, replacing the global connectivity the Delta partnership had provided, now with access to American Airlines, British Airways, Qatar Airways, and Cathay Pacific. Third move, acquiring Hawaiian Airlines out of bankruptcy in September 2024, taking on $1.1 billion in debt to gain wide-body aircraft, Pacific slots, and routes to Japan and South Korea. While Alaska was rebuilding what it lost, Delta did not stand still. In 2024, Delta upgraded its entire trans-Pacific fleet in Seattle to Airbus A350-900s, aircraft that are 30% more fuel efficient than the models they replaced, with premium cabins that justify fares running 40% above market average. It has dedicated check-in desks for Amazon and Microsoft employees. It opened its second Seattle Sky Club in 2024, a 24,000-square-foot lounge reserved exclusively for premium travelers. And it has something Alaska cannot buy: 13 years of data on who flies out of Seattle, to where, in which cabin, at what frequency. That is not infrastructure. It is accumulated structural advantage, exactly the kind that money alone cannot solve. Alaska is arriving on these routes with aircraft its pilots learned to fly less than a year ago. Delta has been on those routes for over a decade. The race is on, but the two competitors are not starting from the same line. The war for Seattle doesn't end when one carrier wins. It ends when one of them decides the cost of staying is greater than the cost of walking away. Neither one is anywhere close to that point yet. If you want to understand the real money moving global aviation, subscribe for more analysis. Until next time.